You believe your credit score is a measure of your financial responsibility, a three-digit number that proves you are trustworthy, reliable, an adult who has their life together. You check it, you nurture it, you protect it. A good score feels like a reward for good behavior, and a bad score feels like a punishment for failure, a mark of shame. This is the story you've been told, and you've played your part in it perfectly. But it's not a measure of responsibility. It's a measure of your predictability. And predictability, to a large system, is just a cleaner word for control. That number isn't a reflection of your character. It's a tool that was designed to shape your behavior, to keep you playing a game that you can't win, because winning was never the point. The point was to keep you on the field forever. And looking back from 10 years in the future, you will see the quiet, devastating cost of playing so well. I'm going to prove it. Let's be honest about how deeply this idea is embedded in our psyche. That score feels like a report card for your adult life. It follows you everywhere. It's a quiet hum in the background of every major financial decision, a gatekeeper standing between you and the life you want to build, the house, the car, the feeling of security. You were taught the rules early, as if they were commandments handed down from a mountain. Pay every bill on time, without exception. Keep your credit utilization low, but never zero. Don't open too many new accounts at once. Don't close your oldest accounts, even if you never use them, because that history is precious. Maintain a healthy mix of credit types, as if your financial life were a balanced diet that required a little bit of everything. And you did it. You followed every rule with the precision of a devout follower. You treated that number like a delicate garden, weeding out late payments and fertilizing it with timely ones. You felt a surge of genuine pride when it ticked up past 780, then 800, then into that rarefied air where you were considered excellent. It felt like you had cracked a code. You were a good student of the financial system. You did everything right. This feeling of competence, of mastery over a complex and opaque system, is a powerful anesthetic. It makes you feel in control in a world that often feels chaotic. It makes you feel smart. It validates the thousands of small, careful, anxious decisions you've made over the years. You've earned your access. You've earned your low interest rates. You've earned your place as a trusted participant in the economy. This is the deep comfort of the game. It gives you clear rules and a visible scoreboard. And for someone who earns well, who is competent and successful in their career, this is an irresistible proposition. It presents another area of life to optimize, to master, to win. It becomes a proxy for success itself. But one day, a strange thing happens. A small crack appears in the perfect wall you've built. It's nothing dramatic. It's a quiet observation that feels like a stone in your shoe, small, but impossible to ignore. You decide to refinance your mortgage to take advantage of lower rates. You come to the table with everything they say they want. You have an 820 score, a pristine credit history stretching back 2 decades, a solid income, and a low debt-to-income ratio. You get a good rate. You should be happy. But a colleague, someone who you know is a bit more chaotic with their finances, mentions they got a slightly better rate from the very same lender a week later. It doesn't make sense. It gnaws at you. Their score is 30 points lower than yours. You dig, gently, over lunch, and you discover the reason. They have a massive new car loan and 2 high-limit credit cards with that specific lender. They are deeply entangled. You, on the other hand, have been systematically paying down your debt. You have fewer, smaller ties to that institution. You've been a ghost, paying quietly and on time, never causing a problem, but never needing more. From the lender's perspective, your colleague is a more valuable long-term customer. Their financial life is an open book of future borrowing needs. They are more predictable in their dependency. You with your perfect score and your disciplined habit of eliminating debt, are a flight risk. You are an excellent risk, but you are not an excellent customer. The system isn't rewarding you for financial discipline. It's rewarding your colleague for their deeper, more profitable dependency. And that's the moment the cold water hits you. The score wasn't for you. It was never for you. It was for them. It's a tool to measure how good you are for their balance sheet, not for your own. And this single, unsettling thought is a wound that doesn't close. You start looking back at all the decisions you made, not for your own financial health, but for the health of that 3-digit number, and the regret begins to pool. The mechanism at play here is called behavioral framing. It's one of the most elegant and insidious systems of control ever devised. It doesn't use force. It doesn't need laws or threats. It works by creating a game, giving you a score, and then framing all your financial decisions around the singular act of improving that score. The architect of this system isn't a single villain in a dark room. It's the emergent logic of the lending industry itself, an intelligence that evolved over decades to solve a simple problem: how to make human beings more profitable. It started simply enough. A company called Fair, Isaac and Company, began developing statistical scorecards in the late 1950s, tools designed to help department stores and finance companies make faster, more consistent lending decisions. For decades, your score was a number you never saw. It was a private signal passed between institutions, used to talk about you behind your back. Then, in 1989, the FICO score launched as a standardized consumer-grade model across all 3 major credit bureaus. And by the mid-1990s, something had shifted. The score began leaking into public consciousness, marketed back to you, the consumer, as a tool for your own empowerment. Know your score. Take control of your credit. Unlock better rates. This was the genius of the flip. The moment the score became a consumer-facing product, it transformed from a passive risk assessment tool into an active behavior modification engine. Who profits from this? The entire credit ecosystem. Lenders profit because they get a population of borrowers who've been pre-trained to act in predictable ways. They learn to self-censor. They avoid making sudden moves that might disrupt their score. They prioritize the health of their score over the growth of their own net worth. They become manageable. You think you are their client. From their perspective, your future stream of interest payments is the product, and you are just the asset that produces it. Credit card companies profit because the rules of the game encourage you to keep old accounts open and to use credit regularly, just to show activity. Insurance companies, landlords, even some employers use the score as a cheap proxy for responsibility, offloading their own due diligence onto a number they didn't even have to calculate. The system frames good behavior not as becoming debt-free, but as being a good debtor. Think about the perverse logic of the rules. Paying off a loan and closing the account can sometimes cause your score to dip. Why? Because you've reduced your credit history length and your credit mix. A system truly designed for your financial health would celebrate the elimination of debt with a parade. This system quietly penalizes it. It wants you to stay on the treadmill. It doesn't want you to be a bad debtor who defaults. But it certainly, absolutely does not want you to be no debtor at all. The sweet spot, the perfect customer, is the person who borrows, pays reliably, carries a manageable amount of debt for a very long time, and obsesses over the score that proves they are doing it all correctly. The framing is so perfect, you end up policing yourself. You become the perfect, willing participant in your own containment. But the mechanism doesn't stop at just shaping your behavior. What it does to the people who finally see it, that's the real trap. And I want to show you what that looks like. Kevin is 48. Project manager. Household income, around $220,000. He is sitting at the kitchen table on a Sunday morning with a cup of coffee that has gone cold. Looking at a single sheet of paper he printed from his financial tracking app. It's a net worth summary. The number is not bad. On paper, he has done well. But he is doing the math that the summary doesn't do for him. The math of what could have been. And that math is not comfortable. He is not looking forward. He is looking back. 10 years back. To be precise, NDAM, DAS, DAM is looking back to the version of himself at 38 who had just crossed 800 on his credit score for the first time and felt, genuinely, like he had figured something out. At 38, Kevin's score was his proudest financial achievement. He treated it like a high-performance engine, constantly tuning and checking it. That year, the kitchen needed a remodel. The quote came in around $30,000. The cash was sitting in a high-yield savings account, ready. But Kevin ran the numbers the way he always did, carefully, optimally. Taking the cash out would drop their liquid emergency fund below his comfort threshold, and a local credit union was offering a home equity line of credit at a low introductory rate for the first year. The logic wrote itself. Preserve the cash, use cheap debt, and the new installment loan would improve his credit mix. It felt like sophistication. He was leveraging his score exactly as he'd been taught he could. At 41, the promotional rate expired. The HELOC reset to standard terms. He was still paying. That same year, a dealership was running 0% financing for 60 months on a new family SUV, but only for highly qualified buyers. Kevin's 800-plus score was his golden ticket. The desire to finally use what he had spent years building was real. He took the loan. 0 interest. It felt like winning. What he didn't see clearly then, sitting at the dealer's desk, signing the paperwork, was that he had bought a more expensive, depreciating asset with a 5-year payment stapled to his monthly budget. The total cost of ownership, the insurance, the depreciation, the loan size itself far exceeded what a used car paid in cash would have cost him. But the scoreboard said he had won. At 44, a thick mailer arrived. Premium Travel Rewards Card. High annual fee, substantial sign-up bonus. He knew he shouldn't open new lines needlessly, but this was another level he could unlock. His score was the key. He opened it. Now he is 48, sitting with the cold coffee and the printed summary. The score is still 815. The nice car is in the driveway, paid off. Finally, 2 years ago, the premium card is in his wallet. The HELOC balance never fully disappeared. It shrank, slowly, but it is still there. And the decade behind him tells a story he did not intend to write. His net worth grew, but far more slowly than his income would suggest it should have. He was so focused on being a good borrower that he became a perpetual one. Every decision he made was technically correct by the rules of the game. Every decision pointed in the same direction, and that direction was not toward freedom. It was toward the center of the system, deeper into it, more entangled with it year by year. The quiet regret that sits with him on Sunday morning is not the sharp kind that follows a single catastrophic mistake. It is the slow burn kind, the kind that accumulates in the space between what you optimize for and what you actually wanted. He optimized for the score. The score was always excellent. And somehow, a decade passed, and the freedom he assumed would come with all that excellence never arrived. It was the wrong scoreboard. He played the game with complete precision and arrived somewhere he did not choose. The scale of this behavioral framing extends far beyond Kevin's kitchen table. Your car insurance rates are influenced by a credit-based insurance score most people don't know exists. Landlords use proprietary rental scores, heavily weighted by credit history, to decide if you're a worthy tenant. Some employers use a version of a credit report in hiring. The logic is always the same. Past financial behavior, as defined by the lending industry, is the best predictor of responsible behavior in all other domains of life. This creates a pervasive, invisible caste system. One where the rules are written by creditors and the scoreboard is a black box you can never fully decode. It creates a powerful incentive to never step out of line, to never have a messy period, a divorce, a job loss, a medical emergency. It discourages risk. How can you start a business that might require you to miss a payment for a few months while you get it off the ground? The long-term cost to your score. Your official marker of trustworthiness is too high. The system demands unwavering, predictable conformity. It wants a straight line, not the jagged, messy, beautiful reality of a human life. Let's run a purely illustrative calculation on Kevin's decade of optimization. The interest on the HELOC after the introductory period. An estimated $4,000 over 5 years. A conservative estimate of the depreciation difference and higher insurance on the new car versus the used car he could have bought outright. Around $8,000 over the life of the loan. The annual fees on the premium cards, minus the rewards he actually used for travel. He would have taken anyway, roughly $1,000. These numbers are illustrative, designed to reveal a pattern, not calculate anyone's personal finances. That's an illustrative $13,000 in direct, visible costs. But the real cost is invisible. What if that $13,000, instead of flowing to lenders and car companies, had been invested in a simple index fund over that decade, running the math at a conservative assumed return? That $13,000 could reasonably have grown to around $25,000 or more, depending on market conditions. That gap isn't just money. It's time. It's compounding. It's momentum that never started. And then there's the cognitive cost. The hours spent reading articles about utilization ratios, tracking score fluctuations, worrying about the impact of a credit inquiry before buying a couch. That is mental real estate that could have been used to negotiate a raise, develop a new skill, or build something that generates equity rather than interest payments. The system didn't just take his money, it captured his attention. And in the modern economy, attention is the most valuable asset of all. So we have to reframe what the credit score actually is. You came into this believing it was a measure of your past, a historical record of your reliability. That is the story they sell you because it makes you feel in control. The truth is, the score is not about your past. It is a prediction of your future. It is an actuarial tool that tells a lender the statistical probability of your future profitability. A high score does not mean this person is financially wise. It means this person has a documented history of managing debt in a way that is profitable for lenders, and is therefore very likely to continue doing so. It is a score that measures your utility to the system. An 820 is a signal that you are a low-risk, high-value asset for them. You pay on time, you are sensitive to the rules, and you are deeply invested in maintaining your status within their game. This makes you a perfect, predictable source of revenue. The ultimate goal of the game, from the system's perspective, is not for you to achieve financial freedom. The goal is to keep you as a permanent, predictable, and profitable customer. A person with no debt and millions in the bank is, from the lender's point of view, a wasted resource. They are not playing the game. They are not generating interest income. They have escaped the gravity of the system. The mechanism is designed to create millions of people like Kevin. Successful, competent people who believe they are winning, while their income, their attention, their ambition is slowly and silently siphoned into the maintenance of a game they were conditioned to believe was for their own benefit. The number they gave you to measure yourself with was always measuring something else. What would change if you stopped calling it being responsible and started calling it what it actually is? The mechanism we just looked at lives in your mortgage. It also lives in your salary, your retirement account, and your credit score. All of them. Same architect,